Insurance Simplified with Leo Jr.
Hello everybody, Leo Jr. coming at you from Gem Young Insurance with my next edition of Insurance Simplified. So everybody knows you need insurance, everybody knows it's important, and we talked a lot in my videos about what insurance does. The next question that everybody seems to want to know is, why does it cost what it does, and how do I get the best price possible? Well, if you've ever thought that, this video is for you. The edition of this video is purely focused on personal insurance, so home, auto, motorcycle, your rental properties, umbrellas, and more. Don't forget, if you like what I have to say, like and subscribe with the link below, and stay tuned for the next video. Anyway, let's get to the first topic. Okay, so I decided to move this to the office because I wanted to use the whiteboard for this next part of the conversation. So, first part of this video is going to be, how is insurance priced? Namely, how do we figure out how much to charge you for your insurance? And in this video, it's all about personal insurance. So home, auto, rental properties, boats, motorcycles. If it's not a business, we're gonna talk about it, other than life insurance. So there's four main categories I wanna talk about, but I wanna preface this by saying there are substantially more minor categories and minor factors that go into your insurance. The truth is, nowadays, we have algorithms, we have predictive modeling, there's computers and AI and all kinds of different technology-driven factors to help us determine your price. What I want to talk about is these four things here to, number one, give you a better understanding, and number two, follow through on that promise I just made you about helping you control your insurance costs. This video is not about finding cheap insurance. This video is about value. So you want to make sure you get the coverages that you need that'll protect you, but you want to do so in a very economical way. That's one of our principles here, fair value. So let's jump in with the first one. The first thing is risk. How your company's doing, current market conditions, and the one I'll spend a little bit of time on later, which is you. So with insurance, you are signing a contract with an insurance company, and they take on part of the risk that you have by living or having an activity or owning or something. Example, if you own a house, there's a risk that house can be destroyed. If you do not carry insurance and that house is destroyed, guess who pays for it? You. If you own that house and you have an insurance policy, the insurance company will help you pay for it. So that's a way to help share the risk with somebody else that has the financial means to support you, so that you don't get completely wiped out in the event of a really bad rainstorm or a rogue cigarette or a fire. Company metrics. Every insurance company is a business, and every business has a bit of a different experience than their competitors. Now, I will say that most insurance companies share a similar experience in the marketplace, but no businesses are run the exact same. So some businesses are more lean and more profitable than others. Some are bigger, some are smaller. So every insurance company has their own profit to keep in mind and how they're structured. So company matters. Current market conditions, which everybody in America and everybody in the world is experiencing right now. We're going to talk about this a little bit, but given that this is such a big deal at the current moment, we're going to spend just a little bit of time on it. And the last thing, what can you do, and how are we tailoring rates to who you are nowadays? So let's jump into the risk part of this, and I'll give you a couple of examples. Okay, so like I just said, riskier things, riskier people, riskier activities cost more to insure. What does that mean? So sometimes risk is danger. Danger could be a super fast, super powerful, super expensive car in the hands of someone that just got their driver's license. Something that's dangerous could be a house in the middle of the woods with the nearest fire department being 20 miles away. Sometimes risk is not always about how dangerous an activity is, or a location, or whatever we're trying to insure, a boat or a motorcycle. Sometimes risk is the amount of items or properties we're taking on. And that's the example I want to give. So in order to, let's use homeowners as an example here, right? Let's say that you have house number one. So home number one is a split level house. It is 1,700 square feet. It is built in 1960, because at least in my area, that's when we built a lot of these houses. And let's say the replacement cost on this house is right around $300,000. Now, just for everybody that's watching, this is an actual example of a home that we have insured. So these are very accurate numbers. And the premium on this annually, right about $1,000. Give or take a little bit, right? That's not an outrageous cost for your homeowner's insurance, because the insurance company's not taking on a lot of risk. if something happened to this house, and let's say it was completely destroyed, the insurance company would have to pay this particular individual $300,000 to replace that house. Now let's use another example. House number 2. So home number 2. This is a 4,500 square foot house. It was built in 1995. It is insured for 1.094. Oops, that's not a million. And it is totally custom. I've seen this house. It is gorgeous, but everything inside of it's custom. The premium on this house is right around $7,000. So this might seem obvious, but this is a really powerful example, because this policy is going to cost a lot more money. This person, this family, is an incredible family, very good people. They don't file any claims. I mean, they're a very clean risk, we would call them, but we're taking on a lot more. So if this house was destroyed, the insurance company has a lot more to lose than if this house is destroyed. So to illustrate this, typically things that cost less are less to insure. Again, illustrates the principle of risk. It's not always proportional, but it's definitely relative. Not to go full statistics on you here, but the next thing that'll play here is what's called a protection class. So property policies are also rated by the effectiveness of the fire department in their areas. So this is in the suburbs. This is what's called a protection class 2. Protection class 2 means that the fire departments in this area are incredibly effective, and the odds of them arriving at the scene quickly are incredibly high. This house is a protection class 7. That means that the fire department is farther away because this is a more rural area. So not only are we taking into account how much we're insuring something for, but we're also taking into account other factors that you as the homeowner have no control over. Where's your fire department? How effective are they? And how likely are they to respond quickly in the event of a fire? Other things we consider are occupancy, so if it's vacant, if it's a primary home or tenant occupied. Other things we consider is if it's a secondary home. So this might be someone's home on the lake. This might be someone's home they live in every day. The reason that matters is if you live somewhere every single day, you're going to see something go wrong. Example, you have something dripping from your ceiling. If that's your home and you look up, you're going to see that. If it's your vacation home and you're not there for 3 months, you're probably not going to see it. Again, sometimes it's how much you take on, but it's also the characteristics of that individual activity, item, or property. Let's move on to the next example. All right, so point number 2 on how insurance is priced, company metrics. So the insurance company you pick matters considerably. Not all insurance companies are created equal, which means not all policies are created equal. Every insurance company does business slightly differently, albeit they have to adhere to their state and whatever state they operate in as Department of Insurance. So there is some standardization as to the products that they use and some similarities. However, they're not all financially the same way. Company metrics such as financial rating and combined ratio help determine how your insurance will be priced. Typically, the companies that have a stronger financial rating, meaning that they are very, very financially strong and very stable, typically also reflect that in their rates. Stable financial companies have stable rates. The other thing that really matters here quite a bit is their combined ratio. I'll get into that in a second, but let's write these down so we have them for a minute. So like I said, you have your financial rating. And then you have your combined ratio. So a financial rating from an insurance company that really matters, at least from where I sit, is called AM Best. AM Best is like JD Power, is like Motor Trend when they have their car of the year. It is an organization that evaluates the financial strength and stability of an insurance company and then gives them a letter grade from the absolute worst all the way to A++, and that helps demonstrate to agents and consumers who has the best financials. So the insurance companies you want to look for are A-rated or better, and if you can get A+ or A++, do it. So A ratings to A plus, A plus plus. And the reason I say this is if you're incredibly financially stable, you don't have to jack up rates all the time because you're doing a really good job of running a profitable, steady business. The companies that are less stable, where they're booming one year, they're busting one year, those are a lot of times the companies that have the huge rate increases. Those are also the companies that are getting killed during claims, and we'll talk about that in the next section. Now, combined ratio. This is a little more of a complex concept, so I'm not going to go fully in the weeds. Let's just talk about this from a high level. Every insurance company spends money to make money, like every business. Insurance companies spend money on a few things. Number one, they have to run their business, so it's overhead. During the pandemic, some of that overhead has shifted, but there's still overhead. Forgive my spelling, that was never my strong suit in school. The next thing they have to spend money on is staff. They have to pay claims. They receive money from new business. That's my job. And then they pay people like me commission to write and service their products. So a combined ratio is their income versus their expenses. A combined ratio of 100 means that their income and their expenses are equal. So let's start with the equal. 100 is equal. A combined ratio of over 100 means they lost money. So let's say an insurance company ran a 105. This means that they spent 5% more than they made, and that's typically either on claims or a poorly managed company. Sometimes they do that for market growth, but what you want to know is companies that are consistently doing this are going to increase your rates. Sometimes insurance companies can't control this, in all fairness. Sometimes this is due to claims, sometimes it's not. Again, companies that are typically up here don't have this very often unless of a horrible natural disaster. Now, insurance companies that run less than 100 are profitable. This is good for you. Rate decreases do happen. I've seen them several times in my career, and I won't name the company, but I have a particular company that's here that takes a rate decrease on one of their products at least once a year. So let's say they run a 95. That means that's profit. So a profitable insurance company is a good thing for not only the board of directors, the agents, the staff, and the underwriters, but a profitable insurance company, especially an insurance company that takes profit in the same place for a while, is a company that will decrease their rate. So what this might mean for you is that they're overcharging you a little bit. Not on purpose, but they overestimated the risk. Sometimes this means they underestimated the risk. A lot of times this is driven by natural disasters or the strength of their underwriting and their prowess. What matters most to you? TLDR, make sure your company's financially stable and ask your agent about their combined ratio. We know this for every company we work with. Most of us are happy to tell you. If you really have that conversation with your agent, we're more than happy to share this with you. Let's talk about the next subject of how the world around us impacts our rates as well. All right, so point number 3, what's going on in the world? Our environmental conditions, AKA the things in insurance you can't control. I don't like things that I can't control. However, you have to know what you can't control because then you can focus on the things that you can. And in my opinion, when you're more educated, you understand the value of insurance a little better. So let's just call this world affairs, right? What's going on in the world, market conditions. So certain things impact how your insurance is priced based on the market. Cost of construction is a really big one here. As everybody in the world knows, it's more expensive to build a house today than it was 2 or 3 years ago, and that's driven by a couple of factors. That could be labor. It could be labor for many reasons. There could be a labor shortage. There could be an educational shortage. There could be a pandemic that is preventing people from working in their profession. I'm not going to go down the labor rabbit hole, but the cost of labor helps impact your rates. Think about it like this. That $300,000 house that we were talking about here, 2 years ago, that house was insured for $230,000. A little bit of tidbit for you. So other things that impact the cost of construction are material. Lastly, Supply chains. So when we're talking about cost of construction, we can also talk about cost of repair. So if we're talking about autos, the cost of the technicians, the cost of the mechanics, the cost of the body shop folks, the cost of your bumpers, your Bondo, your paint. I hope we're not using Bondo anymore. The supply chains. So supply chain is economics. Less supply, more demand, higher price, right? That's what we're seeing right now. And this is not economics 101, but unfortunately that does affect your insurance. So keep that in mind. If you have a very unique vehicle, let's say a Mercedes-Benz SUV, let's say it's an AMG Mercedes-Benz. There's not as many of those as, say, a Chevy Equinox. It's probably a lot easier to find a hood for a Chevy Equinox than a very, very niche Mercedes-Benz. Plus, a lot of those cars are built overseas. So these are all things to keep in mind with your supply chain. So it might be less expensive to insure your spouse's Chevy Equinox versus your more bespoke car. So market conditions here. Inflation. This all kind of equals to inflation in some sort of way. These don't equal inflation, but inflation plays a key role as well. Because not only if labor is shorter and materials are harder to come by, they're probably more expensive now. So when the world experiences inflation, your price will change as well. Again, let's go back to that example. If we have to rebuild that $1 million house, it's going to cost us more than it did a couple of years ago. So we have to charge you more money to account for your risk. Insurance companies, and we're going to talk about claims next, have to also charge based on their claims experience. Actually, you know what? Let's get to claims, because this is a really important part of insurance too. So when insurance companies have a high claims frequency, they have to pay more out. So insurance, let's say this is your insurance company, right? We're going to call it Company X, right? Company X. That was a terrible X. Company X. Company X collects premium, which is your insurance payment, from everybody in their network, right? So everybody that owns a policy over here and over here and over here, over here, over here, you know, we got a lot of policyholders, right? And everybody's paying premium to this insurance company, right? However, you're not paying for exactly what it would cost to rebuild your house. i.e., you're not paying Company X $300,000 every year in case your house burns down. You're probably paying them close to $1,000. What the insurance company is doing is using a calculation to figure out how much money they think they need to bring in from you and me and everybody else in order to pay out claims. So this is money going in. So let's say everybody's paying in their claims, and let's say this family over here, let's say their house burns completely down, right? And let's say they need money to rebuild that. The insurance companies plan for this. The insurance companies know that in every given year, there's going to be a certain amount of claims that happen. They use predictive modeling to predict weather in every other scenario you can think of. What they can't predict is claims exceeding their frequency or severity. So let's say, and this happened during the pandemic, let's say that this now doubled. Maybe they're not collecting enough premium. Let's say that this house burned down, and this kitchen caught on fire, right? Now there's more money flowing out than the insurance company planned for. So what happens at the end of that year is the insurance company might have that red combined ratio, remember? So they might have to say to these folks that didn't have a claim, hey, listen, sorry guys, but we had more claims than we experienced. We need to increase your rates 5% so that we're not only whole for next year, but that we had to dip into some of our reserves, maybe. This is a good example of, hopefully it's a good visual example of how claims impact premium. Certain insurance companies have different claims experience. So if you have an insurance company that's in all 50 states or on the coasts, and you're in Ohio, you might be impacted, by the rates due to a California wildfire or a hurricane in the Gulf of Mexico. If you live in Ohio and your insurance company is only in Ohio, then you would not be affected by any of that, only what happens in Ohio. Again, it's complicated, but this is part of how claims affect your insurance. Now for the good part. Let's talk about some of the things you can do to control your insurance costs and make this as affordable as possible. Okay, so quick recap. We talked about how insurance is priced from a risk standpoint, i.e. the riskier something is, the more it costs. We talked about how an insurance company affects its own pricing, namely how financially strong it is, what its combined ratio is, which is its ratio of income to expenses. Also, we talked about how claims affect your rates. Now, we're going to talk about what you can do about it. The things that you can always control with yourself and your situation is how dangerous you are. Sometimes danger is hard to grasp. So you can control things like your driving record. I am not the slowest driver in the world. I like to drive fast. I got a couple of speeding tickets. My insurance was really expensive. Guess what I do now? I watch my speedometer. So I had to learn that lesson myself too. Insurance companies, again, evaluate your driving record because that's a metric of risk. The next thing you can help. The condition and the safety features of your home or your property. Why does this matter? A lot of you out there are probably like, yeah, duh, of course this matters. Let me explain this a little bit more detail. So the condition and the safety features of your home or your rental property help impact your level of risk. So if you had things like a brand new roof, typically things that are brand new don't break as often or as severely as a roof that might be 25 years old. That's why a lot of insurance companies offer you a discount for having a brand new roof. Insurance companies also offer you a discount for having things like an alarm system and smoke detectors and burglar alarms and fire alarms, because alarm systems will alert you to a problem so you can solve it faster, namely fire. That's awesome. If we know about a fire right away, we can put it out right away and limit our damages. So this is a big discount right here. This is a huge one. If you're talking about why is my auto insurance so expensive, look right there. That is a huge, huge factor. Other things that impact your property are the type of materials you use on your property. Let's talk about plumbing. I don't know how many of you are homeowners or renters or landlords, but different types of plumbing impact your rates. So insurance companies like, we're gonna use green because this is good, insurance companies like copper. Insurance companies like PVC. Most insurance companies aren't a huge fan of galvanized anymore. Galvanized plumbing, over time, the diameter constricts, it clogs, it's old, it's just not very good anymore. So insurance companies don't like that, but they like copper and PVC. The same thing is true for your wiring type. So if you go back to your house that was built in 1999, you probably don't have this concern. If your house was built in the 60s, like mine, then you probably have this concern. Insurance companies really like Romex conduit. Insurance companies really don't like knob and tube. They really don't like these two to the point where they might not even offer you a policy, or if they find out you haven't, they might cancel your policy. Your electrical box is another thing. If you have a fuse system, no bueno. If you have a circuit breaker, that's good for your price. Fuse, not so good. This is an exercise that you should have with your agent, because I listed, 7 factors right here. There are probably 100 more that impact your property rates. So talk to your insurance agent about this. Other things that matter with your property: do you have a pool? Does the pool have a fence? Does the fenced-in pool above ground or below ground? At ground, in ground. I'm sorry. Do you have a swing set? Does that swing set have a fence around it? Is there dangerous features to it? So there's a lot of factors, again, you can take to control your rates, but I want to get back to the high level stuff here. So what else can you do? You ever hear about credit score and insurance? You ever hear of a thing called an insurance score? Probably not. So what an insurance score is an insurance score takes your credit into account, but not solely, and helps what we call the responsibility factor. So insurance companies believe that folks with a higher credit score are more responsible, therefore they're less risky. This happened years ago, but most people are unaware that their credit impacts their insurance. I see this as a huge, huge price factor when it comes to your insurance. If you want to reduce your insurance, pay your bills on time, build that credit. With the companies I represent, the magic numbers are right around 705 to 750. Once you get to that range, your insurance price goes like this. If you dip below a 700, your price goes like this. Again, that's how they believe it. I'm not here to defend it or refute it. I'm just here to tell you how it works. So low credit, high price, high credit, low price. Okay, other things that impact your insurance, again, like we talked about before, are the size and the nature of what you're insuring. Some of that you can't control, and I'm not going to tell you not to. There's nothing wrong with having a really big house. There's nothing wrong with having a custom kitchen. There's nothing wrong with having really nice cars. Just know going into it that when you have that stuff, we have to take on more risk, therefore we have to charge you more. Go back to my claims example. Let's move on to the next point. So the last thing I want to leave everybody with is a list of discounts that I see that every insurance company offers. Again, I'm not here to commoditize my product, but if you have a discount, take advantage of it. So almost every insurance company out there offers what's called a pay in full discount. Pay in full is exactly what it sounds like. You pay your bill in full for the year, they give you a certain percentage off. I've seen it from anywhere from 5 to 18%. Definitely take advantage of that. We're going to call that PIF. Pay in full. If you're on the auto insurance side of this, almost every company out there, at least every one that I work with, offers what's called a telematics program. Some of you might have seen these advertised on TV, but pretty much what it is it's a mobile app or something that plugs into your OBD2 port, tracks your driving from 90 days to 6 months, figures out if you're a good driver or not. If you are, they give you a discount. If they're not, sometimes your rates increase. More often than not, they stay the same. So we're going to call that telematics. That is a whole nother topic for a different video, but if you're interested in this, call your agent. Typically, that's only available on a new policy, so you might have to get a new one. Some of the other discounts that the insurance companies offer. Claims free. One of the things I did not just list up there is how frequent your claims are, because unfortunately you really can't control that. So I don't want to say that's something you can control, but what I will tell you is if claims are really small, don't file them. The most expensive claim in insurance is the tiny ones. So an example of a small claim you shouldn't file. If you have a $1,000 deductible on your homeowner's policy and you have a claim for $800, do not file that. You're not going to get paid, number one, and number two, it's just going to be a clerical mess for everybody, and it's not worth it. That's not blanket advice, but just something to consider in that example. Talk to your agent if you're ever concerned about a claim, and he or she will give you the advice you need. But again, right there, same thing with accidents. If you don't have accidents, you're less risky. You get a discount. Violations is a blanket term we use for speeding tickets. Not all violations are created equal. Some policies even offer to look the other way on your first violation. They call it violation forgiveness or something of that nature. It's kind of a cool feature. One of the other ways to help reduce the cost of your insurance is to get your price ahead of time. This doesn't count if you already have an existing policy, but if you're in the market for new insurance, most insurance companies offer you a discount. They call it advanced quote discount. I absolutely hate that language, the word quote. I don't like, I think it commoditizes our product. But again, I blame my industry. So, advanced quote. Meaning that if you're calling me and saying, hey Leo, we are closing on a house on August 20th. Can you help me out with an insurance proposal for our new home? Sure thing. I do it today, you get a discount, it stays on the policy for 3 or 4 years, and then goes away. From this, every insurance company is going to be a little bit different because they all see the world a little differently. The best thing to do is when you talk to your insurance advisor, make sure that he or she has applied all of these for you. The good news for you is that 99% of the time, these are automatically applied, and your insurance company and your agent doesn't really have too much control over what gets applied and what doesn't. Here's a unique one I found. During the pandemic, I have a particular insurance company, again, which I will not name, that offers you a discount to do your own home inspection. It's really cool. They say, okay, we would spend money to send an inspector out there. If you do it, we'll give you a 25% discount. Again, all of this adds up, and it's not meant to commoditize your product at all. It's just meant to give you the best price going forward. If you think of any other discounts that I missed, or there's any unique ones out there, please drop that in the comments. I'm always about learning new things and seeing what my industry is doing.